What if I told you there's a common cash flow mistake that could land a business owner in federal prison? It's not some elaborate fraud scheme. It often starts with a simple, tempting thought. I'll just borrow from this week's payroll taxes and pay it back later. Here's the problem. In the eyes of the IRS, that's not borrowing. It's a failure to hand over government money, and it can personally bankrupt you and take away your freedom. This isn't a scare tactic. It's a reality that unfolds for business owners every year. They start with good intentions, trying to save their business and keep their people paid. But they make one fatal error. They dip into money that was never theirs to begin with. Today, we're breaking down how a desperate decision to manage cash flow can spiral into a serious federal issue, what the IRS does about it, and how you can avoid this business-ending, life-destroying nightmare. Section 1. The government's money, not yours. So, why is this so serious? First, you have to understand what payroll taxes really are. When you run payroll, you withhold money from your employees' paychecks for federal income tax, Social Security, and Medicare. Here's the critical point. The moment you withhold that money, it doesn't belong to you. It doesn't belong to your business. It legally belongs to the U.S. government. You're simply a custodian. The IRS sees your business as holding that money in trust for the government, which is why these are called trust fund taxes. Think of it this way. If a client gave you a $10,000 deposit to hold for a future project and you used it to pay your own rent, you'd have a serious legal problem. The principle is the same here. Using withheld payroll taxes to pay suppliers, make rent, or even cover the net pay for your next payroll is, in the eyes of federal law, a willful failure to pay over tax. This isn't a simple debt you owe. It's a failure to turn over funds you were entrusted to collect and protect on the government's behalf. And that distinction is exactly why the consequences are so severe. Section 2, a cautionary tale, the story of John. Let's make this real with a story. Meet John. He runs a successful manufacturing company with 30 employees. For years, business was great, but then a recession hits. His biggest client, who makes up 40% of his revenue, is suddenly 60 days late on a massive invoice. Now, John is in a bind. Payroll is due Friday, and a critical supplier is demanding payment, threatening to cut off the materials he needs to operate. He's short on cash. Looking at his accounts, he sees the large sum set aside for his quarterly payroll tax deposit. The thought creeps in, the same thought that has ruined countless entrepreneurs. It's a temporary problem. I'll use the tax money to pay my team and the supplier. As soon as my client pays, I'll put it all back and make the deposit. No one will ever know. So he does it. He pays his employees their net checks and wires the rest to the supplier. He breathes a sigh of relief. He survived. But a week later, his client still hasn't paid. Now, another payroll period is ending. He has to withhold taxes again, but he's even deeper in the hole. The first amount was never paid back, and a new liability is piling on top of it. What was a temporary loan has become a rolling, ever-deepening deficit. He starts paying some bills, but not others, always prioritizing the most urgent operational needs over the silent, looming debt to the IRS. John is no longer just in a cash flow crunch. He's on a dangerous path that can lead to devastating civil penalties and even criminal charges, and he doesn't even realize how much trouble he's in. Section 3. The IRS knocks. From civil penalty to personal ruin. The IRS is an organization built on data and deadlines. They might seem slow, but they are relentless. Their automated systems will quickly flag that the quarterly payroll tax returns filed don't match the deposits they've received. At first, it starts with letters of notice for failure to deposit with a penalty. These penalties start small but grow the longer the tax goes unpaid. John, stressed and overwhelmed, might ignore them, hoping he can fix it before it gets worse. But it will get worse. When the IRS sees the non-payment continuing, the case gets escalated. A revenue officer will be assigned. And this is where a business problem turns into a personal nightmare. The revenue officer will investigate to determine who exactly is liable for the unpaid trust fund taxes. This leads to the Trust Fund Recovery Penalty, or TFRP. The TFRP is not a slap on the wrist. It's a civil penalty equal to 100% of the unpaid trust fund portion of the taxes, the income tax, and employees' share of Social Security and Medicare you withheld. And here's the terrifying part. This penalty isn't assessed against the business. It's assessed personally against any responsible person who willfully failed to pay the taxes. So what do those terms actually mean? A responsible person is defined very broadly. It's not just the owner. It can be a director, an officer, a bookkeeper, or any employee who had significant control over the company's finances. If you had the authority to sign checks, decide which bills to pay, or direct payments, you can be deemed a responsible person. The IRS often assesses the penalty against multiple people. Willfulness is the other key, and it's what traps most business owners. Willfulness does not mean you had criminal intent. It simply means you were aware the taxes were owed and you made a conscious decision to pay other creditors instead. When John chose to pay his supplier instead of the IRS, he acted willfully. His good intention to save his business is not a legal defense. He knew the taxes were due. He intentionally used the money for something else, and that is the definition of willfulness. Suddenly, the corporate veil John thought protected him is gone. The TFRP attaches to him personally. The IRS can now file liens against his home, garnish his bank accounts, and seize his personal assets. This penalty is notoriously difficult to get rid of, even in bankruptcy. Section 4. When civil penalties become prison time. For many, the financial ruin of the TFRP is the end of the road. But for some, it gets even worse. The IRS has a criminal investigation division, and they take payroll tax fraud very seriously. A willful failure to collect and pay over taxes isn't just a civil issue, it's a felony under Internal Revenue Code 7202. When does the IRS decide to pursue criminal charges? It's often reserved for the most egregious cases. Factors include the amount of tax owed, how long the fraud continued, and whether there were efforts to actively hide it. If a business owner like John repeatedly ignores warnings, lies to the IRS, or uses the funds for a lavish lifestyle, a criminal referral becomes much more likely. The Department of Justice regularly prosecutes these cases, and the headlines, which are based on real prosecutions, are chilling. A Dallas area business owner was sentenced to more than 8 years in prison for failing to pay employment taxes, using the money for personal expenses like luxury goods and a $10,000 monthly rent. The CEO of a New Hampshire company got 2.5 years in prison for willfully failing to pay over $14 million in payroll taxes. A California CEO received a year in prison for a decade-long scheme where he underreported wages while using the money to fund a lifestyle that included a $3 million home and luxury cars. In Kansas, a business owner was sentenced to a year and a day for not remitting hundreds of thousands in withheld taxes, using the money for business and personal expenses instead. The law allows for severe penalties. Fines can be substantial, and prison sentences can be up to 5 years for each count. The government's message is clear. This isn't just a business dispute, it's theft, and you can be prosecuted for it. If any part of this story sounds uncomfortably familiar, or if you're a business owner who has fallen behind on payroll taxes, the single most important thing you can do is get professional help now. Don't wait for the IRS to contact you. Don't let the problem get bigger. The IRS is far more likely to work with you on a civil level if you come forward voluntarily. I understand what you are going through. I'm attorney Chad Silver, founder of Silver Tax Group. Call us now for a free confidential criminal payroll tax consultation at 855-900-1040 or visit silvertaxgroup.com. The cost of professional help today is infinitely smaller than the cost of losing your assets, your business, and your freedom tomorrow. The temptation to borrow from payroll taxes is almost always born from desperation. It feels like a temporary fix to a painful cash flow problem. But what starts as a misguided attempt to keep a business afloat can quickly become a direct path to personal bankruptcy and even a federal prison cell. That money was never yours. It belongs to your employees and the government. The moment you treat it as your own, you're not just a business owner in debt, you are committing a serious offense. The choice between paying a supplier and paying the IRS might seem like a tough business decision, but one is a civil matter. The other can end with you being prosecuted for a felony.